Hello and welcome to Financial Intelligence. In this video, I want to talk about exchange-traded funds, or ETFs for short. ETFs have become super popular in recent years compared to mutual funds. There are some great ETFs out there which are among the best investment vehicles for investors. However, there are also ETFs that are actually terrible choices. My point is that just because a vehicle is called an ETF, it does not automatically make it a suitable investing choice. My goal is to provide some pointers to help you stay away from mediocre ETFs in this video. If you like the type of content that I share on this channel, consider subscribing to the channel and don't forget to like this video and also hit the notification bell so that you don't miss any of my future videos. In order to distinguish great ETFs from mediocre ETFs, you should pay attention to these three aspects that affect their risk-reward profile. Number one, ETFs should provide diversification. One of the main attractions of ETFs for investors is that they are an inexpensive approach to diversify your portfolio. For instance, you can get exposure to all S&P 500 companies by purchasing Vanguard's VOO ETF that tracks the S&P 500 index without buying the individual stocks in that index. Since the companies included in the S&P 500 index are from a wide range of industries, their performances are not going to be highly correlated over time. Therefore, investing in such ETFs provides a good amount of diversification to protect your portfolio against sudden fluctuations in one stock or even one sector. However, not all ETFs are designed to provide this level of diversification. There are many new ETFs that are created to provide exposure to a very specific subset of companies. These ETFs are created for investors who believe that certain sectors of the market are going to outperform the overall stock market. However, limited diversification is a big challenge with these ETFs. Since these ETFs are tracking a small number of stocks, they do not provide nearly as much diversification as you would get by tracking more general indexes such as the S&P 500. For example, if you decide to invest in ARKQ Autonomous Technology and Robotic ETF, ARKQ, you are getting great exposure to companies that attempt to build innovative technologies. However, your portfolio is going to be exposed to a set of very correlated stocks. Additionally, it is unlikely that this ETF could beat the average stock market in the long term because many of these new startup companies might not be around in a few years. You are essentially taking a much larger risk in the hope of achieving high returns. If you're investing for your retirement, it is wise to stay away from esoteric ETFs and stick with the ones that offer more diversification. Number two, ETFs should be managed passively. Unlike actively managed funds that require a team of professionals to manage the fund, highly recommended ETFs are managed passively. ETFs have become popular due to their low management fees because they do not hire highly paid professionals to manage their assets. However, this is not the case with all ETFs. Contrary to popular belief, there are many ETFs which are actively managed. In other words, financial institutions that run them hire professional money managers. Their goal is to deliver higher returns by timing the markets when they make their buy and sell decisions. The important point to note here is that these funds are rarely able to beat the market averages in the long term. History shows that some actively managed funds can have higher returns than the market in the short term. However, it has been shown statistically that the vast majority of funds cannot beat the markets consistently over the long haul. Therefore, when choosing ETFs, make sure that you are selecting ETFs that are passively managed. Make sure you look up the management fees of the ETFs on Morningstar's website. I will add the link in the description box below so that you can access it. For example, Vanguard's VOO ETF that tracks the S&P 500 index has a management fee of 0.03%, which is very good. In contrast, ARK Autonomous Technology and Robotic ETF, ARKQ, which is an actively managed ETF, has a management fee of 0.75%, which is really high. Actively managed ETFs can rarely beat the market and passively managed ETFs that track market indexes. So stay away from actively managed ETFs. ETFs should have low hidden fees. On top of the management fees, which are explicitly mentioned in the prospectus of ETFs, there are also hidden costs that are not reported. There are many types of undeclared costs associated with managing ETFs. For instance, consider the cost of rebalancing the funds. Most ETFs attempt to track a specific index, which is essentially a list of stocks. However, because of daily stock price fluctuations, ETFs tend to get out of alignment with their index. What this means is that market fluctuations can cause ETFs to trade at a premium or discount to their underlying assets. When ETFs are materially out of alignment with their index, they need to be rebalanced. The financial institution that runs the ETF usually hires third-party firms called authorized participants, or APs for short, to perform this rebalancing task. The bottom line is that there is a cost associated with rebalancing ETFs, and the cost is passed on to investors. The rebalancing cost affects the performance of the ETF, but it is never officially reported as part of management fees. Note that the total cost of rebalancing depends on how frequently the ETF needs to be rebalanced. ETFs that track indexes which are composed of super volatile stocks are more likely to need rebalancing. Therefore, the costs associated with rebalancing those ETFs are going to be much higher than the cost of rebalancing ETFs tracking less volatile indexes. For example, Vanguard's VOO ETF that tracks the S&P 500 is going to incur low rebalancing costs because the S&P 500 stocks are not too volatile. In contrast, ARK Autonomous Technology and Robotic ETF, ARKQ, is going to have much higher rebalancing costs because it includes many volatile high-tech startup stocks. I hope that you like this video. If you have any recommendation or suggestion, please add them in the comment section below. And don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.